Good evening, everyone. We are just waiting for a few more participants to join the session. So we'll wait for another 2 minutes and then begin the session. Thank you so much for your patience. Good evening, ladies and gentlemen. Thank you so much for investing your time with us this evening. My name is Rashmi and I'm from Great HR and today's moderator of this session. So before I would give you any further details about our session, let's talk a little bit about our topic today, that is TDS, tax deducted at source, right? So as you all know, every employer in India is mandatorily required to deduct tax at source at the time of payment of salary to the employee. And then this TDS on salary payments is governed by Section 192 of the Income Tax Act, right? So today's session is going to be all about this TDS on salary payments. And here we have our expert who will help us understand better about this topic and also will try our best to clarify all your confusions. But before that, I would like to take you through a brief overview on how our session goes. We start off this session with the introduction of our today's expert speaker, and then it is followed by expert presentation, and then we open the forum for the Q&A. So that's when you can start putting across your questions in the Zoom control panel question box. I'll take them up live here and discuss it with the esteemed speaker. Also, this session is currently being recorded and the same will be shared with all of you once we are done with this session. So for any unavoidable reasons, if happens to miss out on any part of our today's session, don't worry, we have got you covered. So for those of you who are new to our Parichay series, let me give you a quick intro on what these sessions are all about. So Great HR Parichay is a series of thought leadership webinars that brings together industry leaders on a common platform to discuss trending HR topics. So the aim of these webinars is to give SME and MSMEs an opportunity to connect with the industry leaders and domain experts and keep themselves abreast of the current trends and information. So under this, we have started our new initiative, Parichay Ask the Expert session. So basically, these sessions are intended to have one-on-one interaction with industry leaders and subject matter experts who would speak on a specialized topic. So at Great HR, we believe this provides our attendees a unique opportunity to meet, interact, and get their queries answered directly by the expert. So on this note, let's welcome our today's expert, Mr. Anurag Jain, co-founder and partner ByTheBook. So let me tell you more about Mr. Anurag Jain. So Mr. Anurag is a qualified chartered accountant with more than 15 years of Big Four experience in advising clients on tax, social security, and immigration matters. Prior to co-founding ByTheBook Consulting LLP, Anurag had a diverse experience in working with PwC, BMR, KPMG, and Deloitte. Also, Anurag has advised larger and medium multinational clients on employee secondment arrangements, compensation structuring, equity incentive designing, and time-to-time support to clients on tax and social security litigation matters. So the recent experience of Anurag includes advising companies on assessing the impact of new labor codes. So Mr. Anurag, welcome to this session. It's our pleasure to have you here.
Thanks, Rashmi. Thanks for such a generous introduction.
So without any further delay, let me hand over the session to our expert. So Mr. Anurag, over to you.
Thanks, Rashmi. So I'm just going to share the screen, and on behalf of Gray HR, I would like to welcome you. Let's hope and let's make this session very, very interactive. And there are some good topics that we are going to be covering in today's session. Just let me just share the screen. Yeah. Okay. So in today's session, while we know that TDS on salaries is at the very heartland of the entire payroll process, but at the same time, over the past couple of years, there are some important developments that have happened, which requires every organizations to have a relook at their entire payroll process. These are primarily legislative related changes, which one needs to factor into, particularly both from the employer as well as employee side. So today we have tried to cover some of the important topics, as well as based on my practical experience, the queries that I have been receiving from various companies. I have tried to basically address and take up those points. So per se, we are not going to be covering the basic aspects of TDS on salary, rather some specific pointers on what sort of changes have happened in the past couple of years and what one needs to take care of in terms of these different aspects. So we'll start with concessional tax regime. Everybody knows that it came in Finance Act 2020. So we'll touch upon it. We'll just first of all re-jog our memory on what this concessional tax regime was all about, what were the various advantages and disadvantages of such a regime, and then what are the nuances of the process that an employer organization has to follow in order to ensure that they can provide such a beneficial regime to their employees. Second, we will basically comment on what are the different processes to follow for declaration to companies, what are the tax impact, and then there are other considerations we would also cover around aspects like taxation of the retiral benefits, primarily superannuation, NPS, and provident fund. And last but not the least, we will also cover on aspects on ESOPs. ESOPs, though not much changes happened in the past, but of course from the startups, we are seeing a lot of startups mushrooming in the past couple of years. So there is a beneficial legislation which have been implemented in Finance Act 2020. So we're going to touch upon that, as well as some nuances around what are the payroll challenges around it. So let's first touch upon concessional tax regime. Now, concessional tax regime, as we must all be aware, is a alternate regime, alternate choice which has been provided to an employee, individual, as well as HUF, wherein they can avail advantage. The kind of advantage that it is providing is in terms of the tax rates. There's a beneficial tax rate. Of course, it will be a progressive rate of taxation, but a beneficial progressive rate of taxation which will be provided to individuals. So just let's have a look and see what are those benefits around it. What is a sort of like overview of this particular regime? So as I was telling, it is an option for individuals and HUF to apply for this regime, again subject to the satisfaction of certain conditions. These options can be exercised every year at the time of filing the return of income. The employee can notify their employer of this option to avail this regime at the time of tax withholding. We will touch upon those process, how an organization needs to basically ask their employees, and how the employees are required to basically intimate their employer on exercising this option. Plus, at the time of filing the return of income, whether the employee can exercise a different option than the one which they would have exercised at the time of basically providing an intimation to the employer, as well as at the time of filing the return of income, is there any prescribed form which has been which needs to be filed by the concerned individuals, and what the main thing is, what are the certain deductions and exemptions which are foregone. So the concessional tax regime, it's a give and take regime. The government has provided concessional tax rate, but at the same time there are certain deductions and exemptions which will be foregone by the individuals when they avail such a regime. Again, there are certain riders attached to it, not only in terms of the deduction exemption, but also for individuals who are earning income from business and profession. So we'll touch upon those aspects as well. Now let's first of all have a look at what is the difference in the tax rate under the simplified regime and under the concessional tax regime. So if you look at 2,50,000, there's not any difference. The tax rates applicable would be nil. But as we progress to different rates, we see, like in the case of a person earning a 5 lakh INR of income, while under the simplified regime, the rate of tax will be 10%. Under the current regime, it is at 20%. Similarly, in case of an individual who might be earning or having a total income of more than 10 lakhs, under the simplified regime, the tax rate stands at 20%, whereas in the case of current regime, it is 30%. On top of it, whatever is the regular surcharge and cess, that will continue to remain applicable under both the regimes. Now, what are the deductions and the exemptions which are basically disallowed? So what people have to be aware about is that there are certain deductions and exemptions which will not be applicable once an employee or the individual opts for the concessional tax regime. Deductions under Chapter 6A, it goes other than the employer's contribution to the NPS, is something which is still available when a person opts for concessional regime. Similarly, in case of an employee, if under the current regime they are availing exemptions such as house rent allowance, leave travel allowance, the standard deductions, professional tax, all this goes in the concessional tax regime. So when an employee opts for such a scheme, they will not be entitled to any sort of like house rent allowance or leave travel allowance, which in a current scenario they would have been able to. Similarly, deduction for allowances like employees in the case of a children education allowance, self-education allowance, this is something which will go. However, transport allowance, conveyance allowance, per diems, or any sort of like travel and transfer allowance, this is something which will still be available. So Sodexos or the food voucher, something again which is very popular industry-wise, and this is something that will go once a person opts for concessional tax regime. Interest paid on self-occupied house property, again a very important factor. People who have bought their own house property, they used to avail this. There's a limit of 2 lakhs as prescribed under the income tax legislation. This is something which will not be available under the concessional tax regime. Now, in this slide, basically what I try to cover is the comparative analysis. In a typical organization, besides a person having a basic salary or the employer contribution to PF, there are different sets of allowances. So in this slide, what we have showcased is that if an organization provides different salary components, what will be the exemption available under the regular tax regime or under the concessional or what we call a simplified regime. So meal coupons exemption is available under the regular tax regime, whereas in the case of simplified regime, the exemption will not be available. Similarly, house rent allowance, allowance on account of your doing your own academic research or upskilling is something which is available but under the simplified regime or concessional regime, it will not be available. Similarly, LTA is something which is not available. Conveyance medical, which were earlier available to the extent of 15,000 in case of medical reimbursement. Conveyance was available up to 1,600 per month. This is something which is not available, both under the regular tax regime as well as the concessional regime. Now, employer's contribution to NPS continues to be available, but the employee's contribution is something that an employee will have to forego once they opt for the concessional regime. Similarly, professional tax is available under the regular tax regime, whereas in the case of concessional regime, it will not be available. Now, some of the apparent advantages to this new regime is around increased liquidity. So people don't have to take their investment decisions based on the tax benefits associated with it. Rather, they would analyze what is the long-term sort of like benefit around this entire investing cycle. So they can take a conscious call as to what kind of an investment instrument or asset they would like to invest in, instead of being purely guided by the tax benefits associated with it. Plus, if you look at benefits like HRA and leave travel allowance, this is something which required the employees to furnish the documentary proof with the employer. Plus, at the same time, the employers are also required to basically keep those proofs for future scrutiny by the tax authorities. In case employee opts for a concessional tax regime, there will be a reduced administrative burden on both the employer as well as an employee. As I mentioned earlier, reduced tax rate is something which is a very obvious advantage of the concessional tax regime. Plus, at the same time, there will be a good amount of flexibility in investment choices for a taxpayer. He will not be guided by the tax benefits, rather he will be guided on the merits of the instrument while investing. Now, some of the disadvantages is, of course, and this was something which was apparent when this entire new regime came into picture, was that there will be lower savings and investment, because of which the individuals will not be encouraged to increase their savings. Rather, they would be guided towards increasing their high disposable income for the purpose of expenditure. So savings is something that will not be encouraged in this particular regime. Similarly, if an individual wants to buy a house and basically avail the deduction on account of the interest payments, there will be no sort of like benefit or the advantages entailed on him on account of this particular scheme. Again, one important fact here is that simply because it has got a lower tax rate, the concessional tax regime doesn't automatically become very beneficial. What we have seen it all depends on a case-to-case basis. It all depends upon a person, what is his income level, what kind of tax savings he have been doing in the past or would be doing in the current fiscal year as well. So one needs to basically do a comparative analysis every year and see which of the scheme would be beneficial to him or her. So again, tax reduction is not guaranteed. It all depends on a case-to-case basis. Tax benefit for investment in house property is reduced. Individuals with house property loans may not be able to find this scheme particularly attractive. Similarly, right now, under the current regime, if you pay for any medical insurance or term insurance, then you used to get those deductions. This is something that will not be there under the concessional tax regime. So one needs to keep in mind that these are the potential deductions that one can lose out if they go in for such a scheme. Now, coming to the process, see, when this entire regime came into picture, a lot of questions was posed by the companies and organization as to how the employer is required to do tax withholding on it. And I remember last year, April 2020, there was a circular which was released by the tax authorities in which they laid down that what is the process. So the process works very simple. What happens is, in case an employee wants to opt for a simplified regime they can basically intimate to their employer, and accordingly the employer will be doing the tax withholding based on the applicable tax rates of that concessional regime. So the process that goes on like this is basically employee intimating the employer and then the employer doing the withholding based on those. And in case the employer doesn't intimate their employer, then the employer will continue to do the withholding based on the current applicable rates. Now, another question that was coming up before me was whether the employees can, during the particular fiscal year, change the scheme from simple to the current regime or vice versa. So that change, once an employee intimates the employer organization on the new regime, then in such a case there is no rollback. But at the same time, at the time of filing the return of income, they can obviously opt for a different scheme. So there's a separate form which has been prescribed by the income tax authorities called Form 10IE. So this is something that needs to be filed prior to filing the return of income, in which the employees are going to be basically intimating that what kind of a regime are they opting for. And this is required to be filed only once a person wants to opt for the simplified tax regime or want to roll back from this particular regime. So one of the common questions that I've been receiving from many taxpayers as well as companies is, once an employee opts for such a scheme, can they roll back for the purpose of withholding? The answer is no. Once you have opted for it, then for the purpose of tax withholding, you will continue to stick with the simplified regime for that particular year. Of course, at the time of filing the return of income, the taxpayer can basically opt for a different scheme. And this requirement becomes applicable, particularly for individuals who are having salary income and doesn't have any income from business profession. Every year, they can change or opt for the simplified regime or roll back there. So pretty flexibility is being given to people who don't have income from business and profession. However, people who do have income from business profession can opt for the simplified regime. But if they want to roll it back in the subsequent year, they can do it. That exit route is available only one time for them. So they can't exercise this option on a multiple year basis. So I'm seeing some questions which are coming up. I think we'll wait, and I'll wait basically to answer those questions in our Q&A session. What I'm going to do is proceed to the next section of our today's presentation. So in the past 2 years, we have seen a lot of queries being received from companies as well as individuals, wherein we saw people getting medical treatment on account of COVID-19. We saw those unfortunate cases, both in the first as well as the second cases, wherein many employees and their family members got deceased, as a result of which there were benefits both on account of medical treatment as well as on account of death, wherein the employer organization were granting some ex gratia payment to their employees. A lot of discussions were happening around what will be the taxability of such a payment. Of course, the situation was getting complicated because of the past circulars which were issued by the authorities, wherein they said that any ex gratia payment made by the employer organization to their employee can be treated as tax-free. But at the same time, there was another legislation, another section under the head income from other sources, which basically led to an argument that such a sort of like benefit can be treated as taxable income in the hands of the family members. So to address this, the tax authorities have came out with a press release. So right now it's a press release. Of course, the legislative amendment is something that has not yet been done. Of course, it is anticipated that in the upcoming budget, these amendments will be carried out. What that press release mentioned was, that any amount which is received by a taxpayer for medical treatment from an employer or from any other person for the treatment of COVID-19 during financial year 1920 and subsequent years can be treated as non-taxable. Further, any amount which is received by the family member on the death of a taxpayer employee from an employer will also be treated as non-taxable. However, in case of family members receive any amount from a third person on account of the death due to COVID, then in such a case, there's a total threshold limit of INR 10 lakhs which has been imposed. So up till that amount, that payment is not taxable. Anything beyond that will be treated as taxable income. Now, while the press release mentioned this particular different scenarios and commented on the taxability of it, some of the questions which are coming up is what will be the meaning of the term, because they have used the term taxpayer in the press release. So what does the tax mean? Does it mean only those individuals who are paying tax, or does it mean individuals who have registered for PAN or who may or may not be filing the return of income? Second important question which is coming up is what is the mode of the financial assistance? Is the government also encouraging people who are receiving cash payments to treat that amount as a tax exempt? Thirdly, what will be the documentary proof which is required to be maintained by the recipient of such amount? And last but not the least, is wherever the employer organization is basically providing such a benefits from the corporate taxation perspective, when the organization would be filing their return of income, will they be allowed a deduction on account of this and treated as more account of payment on commercial expediency? So these are the few questions which are coming up. Of course, it remains to be seen how the government will address it in the upcoming budget. Now, coming to the next section, we'll deal with the taxation of retiral benefits. Of course, in the past couple of years, we have seen government focusing a lot on high net worth individuals availing benefits on both on account of the employer contribution towards the retiral scheme, as well as the contributions made by such individuals towards that retiral scheme. So last year, they came out with this amendment wherein they said that any contribution which is made by the employer organization towards the recognized provident fund, towards the national pension scheme in an or in a approved superannuation fund, wherever such contribution exceeds an amount of INR 7.5 lakhs, then it will be treated as taxable perquisite in the hands of employee. Further, any annual accretion by way of interest, dividend, or any other amount on aforementioned amounts, to the extent it relates to the employer contribution, shall also be treated as taxable perquisite. Now, to arrive at the value of taxable perquisite on account of such accretions, there was a rule, Rule 3B, which was prescribed under the income tax rule. There was a calculation methodology which was also prescribed. It is a fairly complicated formula, but of course, once you start plugging in those parameters, one can arrive at the taxable perquisite value for that particular year. From the payroll side, there are few challenges that I'm seeing. The first and foremost is on account of wherever an employer organization is contributing such scheme and where such limit is exceeded, how will the payroll department basically allocate this amount? So let's suppose we have employer organization contributing towards all these three schemes and the amount exceeds 7.5 lakhs. Let's suppose it's around 10 lakhs. Then how that 2.5 lakhs will be apportioned between all these three schemes is something that has not yet been clarified by the income tax authorities. So I believe some representation have been made in the past asking the government to basically clarify on how this entire computation methodology would work on around the allocation. So it remains to be seen whether any clarity will be provided by them. The second important aspect is they have commented and said in the legislation that annual accretion by way of interest, dividend, or any other amount. Now, in case of NPS and superannuation, what we are seeing is that in case of like NPS, there's a net asset value in terms of the contribution which is made by the employer or the employee. And that net asset value is subject to fluctuation. So let's suppose if today the net asset value at the time of the contribution was 100, and at the time during the end of the fiscal year, it is coming to 150, then will that extra 50 be termed as a sort of like annual accretion? And then whatever is the calculation methodology prescribed under the rule 3B, will that be basically factored into at the time of calculating the taxable PER? But the only flip side is net asset value also keeps on fluctuating. So today down the line, if the equity markets are doing well, the net asset value might be on a higher side. And if tomorrow down the line, the market goes down, then that 150 can convert into 130. In which case, if somebody has already calculated taxable PER on 150, will there be a requirement to basically roll back, or is there any alternative which will be provided? So this is one practical aspect that I have commonly seen many companies trying to grapple with right now, because by and large, majority of the population is contributing towards the Provident Fund scheme. And we know the accretions there are on a specified basis. Every year, the EPFO authorities prescribe those rate of interest. So right now, that much situation is not coming. But typically, wherever organizations have basically formulated NPS in their compensation structure and the employer is contributing towards such a scheme, there we are seeing a lot of challenges. And what are the alternatives? What are the solution is something that I would suggest all these organizations to take a help of subject matter experts, take a guidance from them, and then accordingly basically roll out their tax withholdings for such cases. The third important is how the data sourcing from the employees would work out, because obviously for TF, we know the contribution is made by the employer organization. They file the ECR every month. So data for the PF is not much of a challenge. But because NPS and superannuation data is not primarily, and particularly I would focus on NPS, the data is not available with the employer organization. Then in such case, it becomes all the more pertinent for the organization to source the data on a appropriate timely basis. So Finance Act 2021 brought about another change. So last year, the focus was on employer contribution, but this year the focus was on employees' contribution to PF. And what used to happen up till now was, by and large, the belief is that in case the person has rendered a continuous service of 5 years, then whenever they get that amount or the PF accumulation, that amount is completely tax-free. The Finance Act 2021 has now amended the legislation to tax interest accrued during the previous year on employee contribution exceeding INR 250,000 or INR 5 lakh, depending upon the case. Now, the manner of computing such interest were prescribed in the new rule 3D. Of course, it's a fairly simple calculation. It's not as complicated as has been prescribed in the employer contribution related accretions calculation. So now this change is applicable for this year onwards, and this year the payroll department will have to look at how, wherever such limit is being crossed, how to basically calculate interest. Now, the question which comes up, and what are the areas of challenge for the payroll, is around, first and foremost, the accretion or the interest on account of such incremental contribution which crosses this threshold limit, whether that is a salary income or income from other sources. So what is the classification of such an interest income? If we look at some of the sections in the income tax legislation, it might appear that up to the cessation of the employment, whatever interest is being earned, one should classify it as a salary income. But then there are rulings which say that the employee contribution or the interest on the employee contribution should be treated as income from other sources. So there is a bit of a gray area around it. Second important thing is, we know that the interest on PF is credited by the EPFO, as well as wherever the organizations maintain a recognized provident fund trust. It is basically credited into the accounts of the person on a yearly basis. So now, but at the same time, the individuals may or may not be entitled to such an amount. Of course, it all depends upon satisfying the conditions under the Employees Provident Fund Act. So the next question which comes up is, when this amount will be taxable? Will it be taxable at the stage of the accrual, or on the actual receipt once the employee becomes entitled to receive such IPF accumulations. The third important aspect is around tax withholding. So once the first two is determined, then who will be required to do the tax withholding? In case it's a salary income, then of course the onus falls on the employer organization. For PF trust as well, wherever organizations have PF trust, whether they will be required to do any withholding on such or not, whether the EPFO, which is Employee Provident Fund organization, will be doing any tax withholding on such taxable income or not. Now, if the tax withholding provisions are applicable, then another interesting aspect which comes up is whether that withholding is required to be done under Section 192, which is a salary related to tax withholding, or 194A, which is a withholding on the interest amount, or 195, depending upon the residential status. So in case a person is a non-resident, then in such a case, wherever such payment is being made, the TDS provisions of Section 195 would be applicable. Coming to the last section of our today's slide, we'll focus on the equity incentives which have been issued by startups. We know there has been a good number of startups which have come up for IPO. The startups provide ESOP benefits to their employees because it promotes the retainership of the employees, but at the same time keep them motivated. From the organization perspective, it is a good compensation strategy wherein upfront they don't have to basically pay anything. They basically provide them those equity benefits, and at the point of the exercise, the taxability happens. Now, this change came in Finance Act 2020, and this was primarily to do with the eligible startups. So what this law says is basically that any tax in relation to the specified securities or sweat equity shares up until now were collected at two stages. First is a perquisite when the option is exercised, and later is capital gain at the time of the sale of such securities. Now, effective financial year 2021, eligible startups, I'll come and basically also specify what are those eligible startups, what is the definition of the eligible startups, will be required to deduct tax in relation to this such ESOPs or equity incentives within 14 days of the earliest of the following event, which is 5 years from the financial year in which the specified security or sweat equity is allotted, transferred to the employee, which is typically expiry of 48 months from the end of the relevant assessment year, or the date of the sale of specified security, or the date of cessation of employment. So all these three events, whichever occurs earlier, will trigger or will require the organization to basically deduct taxes and deposit it within 14 days. Now, coming to the point of what are those eligible startups. Now, eligible startups is basically any company or limited liability partnership who are engaged in an eligible business and satisfies the condition like it is incorporated on or after 1st day of April 2016. It has got a total turnover of the business doesn't exceed 100 crore rupees. And the most important thing is it should hold a certificate of eligible business from the government authorities. So wherever such conditions are satisfied, the eligible startup will be able to take benefit of this particular deferred collection of taxes. So this particular clause doesn't mean that the income or the perquisite will not be taxable. Rather, there will be a deferred collection of taxes of such an income. So because of the deferred collection aspect, from the payroll side, the main challenge is to basically, they will have to maintain a track of such allocation of equity incentives. They have to keep track that when these were exercised by the employee and when they would become eligible based on these three conditions. Whichever conditions get triggered, then it will be the onus on the payroll department to basically ensure that the TDS is deducted and deposited with the tax authority in the due course of time. So I think with this, I have come to the end of my section. And the next session is what I'm looking forward to. It's a Q&A session where I look forward to your queries. So over to you, Rashmi. You can start shooting the questions which has been raised by participants.
Sure. Thank you, Mr. Anurag. I think you shared some wonderful information with us. So the audience will now head towards the Q&A session. So if you have any questions, please put it across in the Q&A option of Zoom control panel. We'll be happy to take it up here. And Anurag, I can already see there are a few questions lined up. So I'll take up the first question, which is from Abita. Hi, Abita. Abita's question is, what is the concession given for women employees under income tax?
See, for women employees, I remember earlier there were certain limits, I think a couple of years back, wherein for a resident women, there was a concessional tax rate applicable. But now that has been rationalized. I think now there are three income tax rates. One is for a normal individual. Second is for individuals who qualify as senior citizen. And third is for individuals who qualify as super senior citizen. So there's no concession per se for women employees under the income tax regime.
Sure. I hope that answers the question, Abita. And Anurag, next question is from Sonam. Hi, Sonam. So Sonam, question is, can we switch back to old regime if we have opted for new regime already?
See, switching back option, as I was telling, is available, but it is available only in the subsequent year. So the way it would work is, in case an employee has intimated their employer that he would like to opt in for a simple or the new regime, then in such a case, that employee won't have option for the purpose of the withholding to go back to the old regime. Then in such a case, the tax withholding will happen under the new regime. But at the time of filing the return of income, they always have the option to basically go in for the old regime and file their return of income based on the old regime tax rates. So that option is available with an employee.
Sure. And also we have another interesting question, Anurag. So the question is, are there any rebates for purchases made by employees for accommodating work from home option, such as purchase of a work desk, equipment, etc.?
Unfortunately, and this is a very good question, because we saw in the past years, since the pandemic has begun, many employees working from home. And in fact, this is one of the very common problem that organizations are facing, that when an employee is sitting at home and they have purchased like desk or furniture, can they get any sort of like deduction around it? If we look at the current tax legislation, and we have to keep in mind that per se the government has not come out with any sort of like advantages for people who are working from home. Because if we see globally, there are countries who have doled out certain benefits for employees who are working from home. But in India, we haven't yet seen those advantages coming. But if we look at the current tax legislation, it says that wherever employer are providing any facilities in terms of, let's suppose, furnitures or any other sort of like hard furnishings, then there is a taxable perquisite value that needs to be accounted for. So as per the current regime, there is a taxation which happens. Of course, there are rates which are specified under the income tax rules for taxing it. Laptop is something which, if an organization provides to an employee, is completely tax-free. So that is something that can be availed. And we have seen a couple of organizations implementing such sort of like benefit in their compensation structure. Apart from that, if their organization is providing medical benefits, of course, one needs to see what kind of medical benefits have been provided. Are these medical benefits provided uniformly to all the employees in the form of like group insurance or any COVID-related benefits? As I was telling, the COVID-related treatment benefits is something that can be easily treated as exempt. Now with the press release coming up, of course, we'll need to see how the legislative amendment comes about. But apart from that, there's not much benefits for people who are working from home. So in case an employee is thinking, okay, let me buy something additional which will facilitate me from working from home, there's not that much amount of benefit available to them. We have also seen companies, whenever a new joinees are coming on board. We have seen, and in social media platform as well, we have seen people posting the clips of thanking the organization that they have provided them laptop and some other ancillary items as well. So that is something which is tax free, because uh, it is for the purpose of official usage only. Anyways, employees who were working in an office environment, they used to get those facilities. So when they are getting these facilities at home, they can obviously treat it as a tax-free item.
Sure. So I think that answers helps all of us a lot. Thank you so much, Anurag. And next question is from Mr. Kiran. Hi, Kiran. Kiran's question is, if an employee opt for old tax regime in current financial year and filed an ITR, and later he has an option to change it to new tax regime?
That's a good question, because once you file the original return of income, whether they can file a revised return of income under the different regime. My guess would be yes, one can do that. The reason I'm saying so is the government provides you the facility to revise your return of income. Now, the only thing which remains to be seen is when I was talking about 10IE. Now, that is the form that has been prescribed by the income tax authority. So whenever you're opting for a new regime, you would have to basically file that at the time of filing the return of income. Unfortunately, we haven't seen utilities released by the department. So right now, I don't think the employees are basically, whenever they are filing the return of income for 2021, are they going to be uploading that particular form or not. So right now they might be filing the return of income based on whatever they have opted for and uploaded it. In case they want to basically revise it under the different regime, they can do it by filing a revised return of income.
Sure. Thank you, Anurag. So Kiran, I hope that answers your question. And Abhita again has a question for us, and it seemed to be interesting, Anurag. So the question is, how much the VPF amount is exempted for employees?
See, VPF amount is nothing but a voluntary provident fund. So as I was saying, in this year's budget, they have said that wherever an employee is making a contribution which exceeds 250,000, that amount or the interest earned out of it will be taxable. For the purpose of Section 80C, the limit continues to remain at 150,000. So wherever a person is contributing on a voluntary VPF, that limit of 150,000 continues to remain.
Okay. So Abhita, I hope that answers your question. And Anurag, another question is, how do we classify PF as salary or income from other sources?
How do we classify income? See, Provident Fund income is divided into 4 portions. One is the contribution by the employer and interest earned on it. And the second is the contribution made by the employee and the interest earned on it. Typically, people who have rendered a continuous service of 5 years or more, when they leave their employment and they apply for the withdrawal, that whatever amount they received is tax-free up until now. Okay, I'm not going into the aspect of whether that contribution was above 250,000 or not. Let's take a simple case scenario. So in such a case, it is tax-free. Now, in a case where a person has rendered a service of, let's suppose, 3 years or 4 years, and he or she leaves the employment and withdraws that amount, let's suppose they basically venture out for self-employment, then in such a case, there is a taxability around it. And the way the taxation works is basically the income, any provident fund contribution made by the employer is something which will be added back to the and treated as an income under the head salary, as well as the interest earned on that employer contribution will be treated as salary income. As far as regarding the contribution made by the employee is concerned, any amount of deduction which he or she would have been availed under the Section 80C, it will be rolled back and added back. Plus, any interest on the employee contribution will be treated as income from the other sources.
Sure. So I hope that answers the question. And we have another good question, Anurag. It's from Mohan Kumar. Hi, Mohan. So Mohan's question is, every year I have a query from my employees that employee and spouse are working and whether both can use the same investment receipt while submitting the proof.
See, investment receipt is usually in the name of one person. So I haven't seen or come across any situation wherein a person has made an insurance payment and that the insurance receipt is in the name of both the person. Normally, when you take a, let's suppose, if I have taken a medical policy, it's a family floater policy. I would have taken it, bought it under my name. I would have made the payment. So the policy per se would be under my name, and then there will be beneficiary, which might include my spouse and my children. In which case, the receipt would be in the name of myself, and in which case, if I submit it, I will get those necessary deduction. Complications come in cases like wherein house property has been purchased under the name of both the spouse as well as the individual. Then in such a case, that particular proof can be used for submission before the employer organization, and based on that and certain declaration that they would receive from the concerned employee, they can basically provide that advantage or the benefit to the employees.
Sure. Yeah. So I hope that answers your question, Mohan. And Anurag, next question is from one of our attendees, Malleshwara Ram. So this question is very interesting. So the question is, what is the maximum limit for donations which fall under Section 80G?
What is the maximum amount? See, there's no maximum amount. Maximum limit is, there's no maximum limit which has been prescribed under Section 80G. What Section 80G says is basically that wherever you are making a contribution, depending upon the kind of a trust or the kind of organization to which you are making, then in such a case, you will be entitled to a deduction. And this deduction can be in the range of 100% or 50%. So if you're making a payment to Prime Minister's National Relief Fund, you will be entitled to a deduction of 100%. If you're making to any other trust, then there will be a 50% limit around it. So per se, overall, there's no cap around 50G, 80G. But at the same time, it all depends upon the kind of organization wherein you are making those donations.
Sure. So I hope that answers the question. So Mr. Malleshwaram, it is purely dependent on the components there. So I think that helps you go further with it. And Anurag, we have next question about the regime. So the question is, which regime is better for the employees who are earning, whose earning is not more than 20 lakhs per annum?
See, if their earning is not more than 20 lakhs, but of course, if it is more than 15 lakhs, so coming back to the question, it all depends upon the facts of the case. If that individual has been availing advantages like HRA or income from house property on account of the interest payments or LTA or any other advantages that he would be taken, it is always better to basically go in for the old regime. I have typically seen that people who are at a higher income bracket, wherein they have been availing such exemptions, like employees' contribution to NPS, plus there is a standard deduction also which is available. In such a case, it makes more sense to stick with the current regime rather than going for the new regime.
Sure. So I hope that answers the question. Next one is from Vaishni. So the question is, can you help us understand how can we give exemption for fuel reimbursement and driver salary?
Yeah, that is another interesting question. See, exemption for fuel reimbursement and driver salary is available, but it all depends upon whether the car facility has been provided by the employer or it is something that you are using your own car. If the car facility has been provided by the employer, which is typically car lease, where an employee either owns the car or hires the car and then provides to the employee, then there's a flat rate of taxation, which can add a value to your compensation structure, because that flat rate of taxation is around 1,800 per month or 2,400 per month, depending upon the cubic capacity of the car which has been provided. Plus, at the same time, if a driver facility is also been provided, there's an added benefit of 900 per month. So the taxability will work out irrespective of the kind of fuel reimbursement or driver salary you are actually paying or reimbursing to your employees, the taxation will be 1800 plus 900 or 2400 plus 900, depending upon the kind of car that has been provided. So that is a big plus of a company leased car. However, if the company is just providing you fuel reimbursement and a driver salary reimbursement, then the benefit is limited. Because what will happen is, if an organization is providing, let's suppose, a reimbursement of 60,000 within your CTC, then the taxability will work as 60,000 minus 1800 plus 900, which is 2700 per month, will be the delta, or the difference will be treated as the taxable income in your hands. So the benefit in case of employee-owned car will be restricted to 1800 or 2400 plus 900 if the car driver facility is provided. But in case of employer-owned car, the benefit is or the taxability is restricted to 1800 or 2400 only.
Sure. Thanks, Anurag. I hope that answers the question. And also, Anurag, we have another question which could be sort of a repeat question, but I'll still take it up. It is from Mr. Shafat. So the question is, if we file the return under section 139(1), according to the new regime, can we file revised return under section 139(5) according to the old regime for the same assessment year?
See, if it can be filed, because as I was telling earlier, when you file a revised return of income, your original return of income becomes void ab initio. So typically what happens is, once you file a return of income, thinking that the simple or the concessional regime was more beneficial, but then you later on realized that the current regime was more beneficial, and there might be some refund which is coming around, you always have the liberty to go in for filing the revised return of income. The only thing, and a big caveat that I'm inserting here is, because the department has not yet released the utility for 10IE. So one would have to see if at the time of filing the return of income, whether the individual has the flexibility to again refile the form 10IE or not. So that is something that one would need to see.
Sure. Thanks, Anurag. So, Mr. Shafat, I think that answers your question. And we have another good question from Payal. So the question is there any link or site where we get all information about PF, because we are a startup and now going to start a PF facility for our employees? So want to know all about rules and regulations of PF.
See, the regulations around the PF is quite complicated, depending upon what kind of employees is an organization's employee. So if the employees are at a fairly higher bracket, then of course they always have the liberty to opt for PF on a voluntary basis, depending upon whether it is their first organization or not. For people who want to understand about the PF legislation, I would say go in to the EPFO website. There's a lot of resources, a lot of material. They have also the bare legislation there. So one can go and basically browse around and see what are the different circulars which have been released by the department over the years. Plus, at the same time, have a look at the PAYER Act, and they also have a good FAQ section as well, wherein most of the queries are addressed in that FAQ. So I would say EPFO site is the best resource if one wants to do a research or do a sort of like self-study around it.
Sure. Thanks, Anurag. And we have another question now. It is for the employees who are traveling for long distance to work every day. So the question is, for employees who are traveling long distance to work every day, can they claim actual conveyance incurred as a deduction without any upper limit? If yes, under what section is it allowed? And would they need to provide proof to the company to allow this deduction?
See, on this, there are 3 important points here. One is, we were aware that conveyance allowance was being earlier provided. There was an exemption of 1,600 per month, which was provided by the income tax legislation. Now that allowance is no longer there. Instead of that, the government has come out with a standard deduction. what that particular description of that allowance was focusing was an allowance which is provided to an employee to commute from home to office and vice versa. So per se, the government intention was that this commute is per se commute for the purpose, for personal purposes, not official purposes. That is point one. So conveyance allowance is no longer there, and accordingly, individuals who want to avail any benefit out of it is they can't do it. Coming back to my old response, wherein I was saying that there are two sort of like alternatives available in such case. One is the employer-owned car. In this case, I think the employee would be owning their own car, and they might get a reimbursement from their employer organization. In this case, it is suggested if they can basically ask the organization if such sort of like facility or reimbursement is available, or make it a part of their CTC, in which case they can submit the bills for the maintenance, for the insurance, for the petrol with the organization, and the organization will give them the reimbursement. The section is section 17 and rule 3 under the income tax rule. So the concerned individual can have a look at those sections and see which is more beneficial. In terms of proofs, yes, the proof is the copy or the original fuel bills, original invoice of the repair and maintenance of the car, or receipts which would have been paid to driver's salary. So these are the typical documentary proof which needs to be submitted. Rashmi, I think you're on mute.
Yeah, so sorry, Anurag. Yeah. So, dear attendees, as you can see, we are running short of time. So, we are trying our best to take up your questions, but I think since we are very left with any time, I'll be able to take up last two questions for the day. So, the next question is from Mr. Naresh. It is about Sodexo coupons. So, Anurag, the question is, what is the limit for Sodexo coupons?
So limits for Sodexo coupon is 50 rupees per meal per day. So typically in an organization, if an organization has a normal shift of 9 to 6, so you can say breakfast and lunch is something that they can cover. So organizations can provide 100 rupees per day to their employees as Sodexo, so which will typically turn out to be 2,000 rupees per month and 24,000 per annum. So that sort of limit is something that can be prescribed by the organization and make it a part of their compensation structure.
Sure, thanks, Anurag. And the last question for the day is from Mr. Manish. Hi, Manish. The question is there any obligation of employer to deduct tax on PF plus VPF contribution, which is more than 2.5 lakhs in current financial year? So according to new guidelines, interest is taxable if amount is more than 2.5 lakhs.
Yeah, no, that's a very good question, and this is something that I highlighted in my section. So right now, what is happening is wherever such threshold limit is being crossed, the number one thing which is being asked is what will be the classification of such a interest income, whether it will be classified as income under the head salary or income under the head income from other sources. So that is first question that one needs to answer. There are gray areas around it. I'm going to be very, very frank about it. Of course, sort of like a detailed study is required to be done in order to understand. Situation would become a little bit more complicated in case of organizations having private PF trust. But in a normal setup, the first question that one needs to understand is whether whatever interest is being earned, is it income from other sources or income from salary? Once that is done, the second question comes up, what will be the taxability? Will it be taxability in the year of accrual or the year in which the actual accumulations are being paid? And the third important question is, who will be required to do the tax withholding? Whether there is any onus on the employer organization, particularly for those organizations who don't have any private PF trust, to deduct any interest or deduct TDS on such taxable amount. So these are important questions there, and what we are seeing is companies are grappling with this scenario. And of course, as we are approaching the close of the fiscal year, these questions will come up. We also would need to see what sort of clarity is being brought about by from the government side all those representations have been made with the government to provide a much needed clarity on such like scenarios. And at the same time, organizations are basically doing a sort of like study around it. They are taking opinions from subject matter experts as to what will be the taxability scenarios around it, whether there is any obligations cast on them or not, or what will be the implications if they don't do any withholding on such an amount.
Sure. So I think with this now we are done with the Q&A round. So Mr. Anurag, if you can stop sharing the screen, would be of great. Yeah, thank you so much. Yes. So dear attendees, if any of your questions are unanswered, please don't be disappointed. You can definitely reach out to us and also our expert, Mr. Anurag Jain, on our community forum, that is Great Tribe. And Community Tribe, the Great Tribe is actually a Q&A forum where lots of knowledge is being shared. We have many more HR peers like you, and we also have expert panel like Mr. Anurag and other industry experts there. And here's the link. And this sign up will be completely free of cost. So please do sign up and be a part of our Great Tribe and get the utmost benefit out of it. And also, before I would do this small announcement here. We have our next upcoming Parichay session on 9th December, which is the next Thursday. In this session, we will be discussing on how organizations are planning to their employees back to workplace as offices slowly reopen. So you will definitely get the registration link of this session in that. Please do there, register for this session and do not miss this session. Again, I'm repeating it. The next upcoming session of Parichay series is on 9th December, Thursday. And here is the panel that we are going to have in this session. So please do utilize this. So on this note, I think it's now time to end the session. Also attending making the session successful. And thank you for taking a session. Have a great time. Thank you.
Thanks, Rashmi, for having me, and thanks to all the participants.